Welcome back to the Deep Dive. Today we are opening a file that usually sits on the very highest shelf of the financial library.
That's a good way to put it.
We're talking about a strategy that tends to get whispered about in boardrooms right before a major business exit, or maybe when a family office realizes their liquid capital has hit a specific kind of uncomfortable threshold.
It's only uncomfortable because the tax implications become so massive. And today, we are strictly looking at the structural reality of private placement life insurance, or PPLI, as most people call it.
And I want to stop you and the listener right there. If you just heard the word insurance and your eyes started to glaze over, please stay with us. This is not about buying a policy to cover funeral expenses. We're talking about what the ultra-wealthy refer to as a tax-efficient wrapper.
Yeah.
It's, effectively a container for wealth.
Right.
But because we are dealing with some very serious regulations and, let's face it, heavy financial machinery, we have to start this deep dive with a very specific set of ground rules.
It's absolutely mandatory. We have to set the stage correctly on this one.
Exactly. So please listen closely to this. Before we dive in, this episode is for educational purposes only. We are not providing financial advice, tax advice, legal advice, or investment recommendations. Private placement life insurance is a complex financial structure that requires consultation with qualified professionals, including PPLI specialists, tax attorneys, estate planners, and investment advisors. What we discuss today is conceptual education to help you understand what PPLI is, who it's for, and when it might or might not be appropriate. Never implement any strategy discussed here without working directly with experienced professionals who understand your specific situation.
Perfect. And that disclaimer really frames our mission for today, We are not here to sell anything.
Not at all.
We are here to take a professorial kind of balanced look at the mechanics. We want to arm you with the vocabulary so that if you fit the profile, you can sit across from a specialist and actually understand what they're proposing.
Instead of just nodding along while you talk about mortality charges.
Exactly.
So let's strip it down. When I hear private placement, I think of unregistered securities, maybe hedge funds. When I hear life insurance, I think of a death benefit. How do these two concepts even crash together?
You have to stop thinking of PPLI as insurance in the retail sense.
Yeah.
It's not whole life or universal life. Think of it more as a customized wrapper, a legal container.
A container for what, though?
For assets. Ideally, for high-yield, tax-inefficient investments, you fund the policy with cash or, in some pretty sophisticated cases, with actual business assets.
There.
Once those assets are inside that wrapper, the life insurance code kind of wraps around them and, well, it creates a shield.
And the function of that shield is basically to block the IRS.
It changes the tax environment completely. I mean, outside the policy, every time you sell a stock, you trigger capital gains.
Right.
Every time you get a dividend, you pay income tax. That's what we call tax drag. Inside the policy, your investments grow without that annual friction.
So no capital gains tax on trades inside the wrapper. No income tax on dividends.
That's right. So if you have, say, a hedge fund strategy inside this wrapper and it's churning out 20% returns, you're not writing a check to the Treasury that year on that growth.
Okay, but I need to be precise here because the terminology really matters.
Yes, please.
It's technically tax-deferred growth. It's not magically tax-free the moment it happens. It grows tax-deferred. The tax-free part, that refers to how you access the money later on.
Which is the part everyone cares about. How do you get the money out without triggering that huge tax bill?
You use leverage. You don't withdraw the money. You borrow against the cash value of the policy.
At what kind of rates?
Usually very low rates, often spread-linked, so maybe 1.5% to 2%. You're essentially borrowing from yourself.
And loan proceeds aren't taxable income.
Exactly. So you're accessing your capital tax-free. And the loan balance is just what sits there.
It accrues. Then, when you eventually pass away, the death benefit pays off the loan principal and interest, and whatever's left goes to your heirs.
Okay, so fund it, let it compound without friction, borrow for liquidity, and then settle the tab at death. The math creates a massive advantage. But the IRS isn't in the business of handing out loopholes without some serious strings attached. What's the catch?
The catch is control. Specifically, something called the investor control doctrine. This is the rule that really trips people up.
That sounds ominous.
It's strict. To maintain the tax advantages, the IRS demands that you, the policyholder, cannot have incidents of ownership over specific investment decisions.
What does that mean in plain English?
You can't wake up, read a report on tech stocks, call your manager and say, Sell NVIDIA and buy Google today.
I can't trade my own account,
Eh,
even though it's my money.
Absolutely not. If you direct the day-to-day trading, the IRS will look at that structure and say, look, this isn't insurance, this is just a brokerage account you're hiding from us.
And they'll collapse the structure.
And you'll owe back taxes and penalties. It's a disaster.
So you really have to hand over the keys.
You hand over the keys to the car, yes, but you still tell the driver the destination. You set what's called the investment thesis.
Okay.
You tell the independent investment manager, I want a strategy focused on high-growth equities, or I want a private credit strategy yielding 8%. You set the risk parameters, the asset allocation, but they execute the specific trades.
That distinction is just.
Yeah.
It's vital, and it creates a very specific profile for who this is actually for because, frankly, this doesn't sound like a product for the average 401k saver.
No, not at all. The fees alone would destroy the value for them. We are looking at a very specific demographic. First, high net worth individuals. Generally, the industry standard is you need at least $10 million in liquid capital.
10 million. Liquid. We're not talking net worth tied up in your primary residence or your art collection.
Right. Cash or marketable securities.
Yep.
Or you're a business owner anticipating a massive liquidity event. We're talking about an exit of $50 million, $100 million, or, much more.
Why is the threshold so high?
Because the setup costs and ongoing friction, the legal fees, the mortality charges, the admin fees, they're substantial. If you have less than $10 million to deploy, the fees just eat up the tax benefit.
Right, the arbitrage doesn't work.
It's also for the alternative investor. So if you're already putting money into things like hedge funds or private credit that generate high ordinary income tax, PPLI is a fantastic home for those kinds of assets.
And what about psychologically? You mentioned the investor control doctrine. That feels like a personality test.
It is the psychological fit. This is for the strategic allocator, not the active trader. If you're someone who needs to feel the pulse of the market and click the buy button yourself, you will absolutely hate PPLI.
So if you're a control freak, stay away.
100%. You have to be comfortable with complexity and comfortable being hands-off on the day-to-day.
Okay, let's talk timing. If I fit that profile, I have the liquidity, I'm okay with the structure, when does it make sense to, pull the trigger on this?
There are three main windows. First is the liquid capital now scenario. This is the simplest one. You just sold a company or you inherited wealth. You have $20 million sitting in cash and you want it to compound efficiently for the next 30 years.
Straightforward. What's number two?
Pre-exit planning. Now, this is the sweet spot for a lot of entrepreneurs. You're maybe 1 to 5 years away from selling your business. You think your company is worth $50 million today, but it could be worth $100 million in 3 years.
You want to structure this before the sale to capture that future growth inside the wrapper.
Precisely. And the third scenario is pure estate planning. You're looking at generational wealth transfer. You want to fund a dynasty trust and avoid that massive 40% estate tax bite.
Are there times when it's just a flat-out bad idea?
Oh, absolutely. Too early is a big one. If you're a startup and you don't know if you're going to be worth $5 million or zero, do not do this. You need that cash for the business.
Not locked in a policy.
And too late can also apply. If you've already sold the business and paid all the tax, you missed the chance to optimize the transaction itself, though you can still use PPLI for the cash you have left over.
Okay, so let's drill down into the why. We've touched on the tax drag, but break down the core benefits. Why go through all this headache?
The biggest driver is tax efficiency on future growth. It really is just simple math. Let's say you have $50 million. If that grows to $200 million over 20 years outside of a PPLI.
You're paying tax on that $150 million of growth every step of the way. Dividends, rebalancing capital gains.
Exactly. Inside PPLI, you pay zero tax on that $150 million of growth while it's compounding. That difference over decades can almost double the net wealth available to your family. It's huge.
And the loans solve the liquidity problem, which is a major concern for people.
Right. You're not saying goodbye to your money. You can access it. But here's another benefit people often miss. Income tax savings on business contributions.
How does that work?
If your business is owned by the policy before you sell it, the profits that business generates are inside the wrapper. So if your company makes, say, $20 million in profit the year before the sale, and it's inside the PPLI.
That $20 million isn't hitting your personal 1040.
Correct. You can reinvest 100% of that profit, tax deferred. It's incredible leverage. And finally, asset protection. When you structure this inside a proper trust, which is almost always how it's done, it is incredibly difficult for creditors or lawsuits to get to it.
It's kind of ironic that loss of control we talked about, that can actually be a benefit, can't it?
It creates emotional discipline. You physically can't panic sell when the market drops 10%. You're forced to stick to the long-term thesis you designed.
We're getting pretty deep in the weeds here, and I do want to talk about the downsides because there are plenty. But first, I think we need to pause for a really important reminder.
Good idea.
Quick reminder. Everything we're covering today is educational. PPLI is not a one-size-fits-all solution. If you're exploring this, you absolutely must work with the PPLI specialist who has done cases like yours before. We're teaching concepts here, not making recommendations.
Crucial point. Now let's look at the other side. Why would you not do this? What's the friction?
I'm guessing the fees are the first and biggest hurdle.
They are heavy. I mean, you have legal fees just to set the thing up. We're talking $50,000 to $150,000 up front before you even fund the policy.
Wow.
Then you have the insurance costs, the mortality charges, because legally it has to be life insurance, plus investment management fees and admin fees. The tax savings have to be bigger than all those layers of fees.
Which is why that $10 million floor exists. Below that, the fees just eat all the benefits.
Precisely. And we've talked about the loss of direct control. For some people, that's just a deal breaker.
If you believe you're the best stock picker in the world,
Then walk away. This isn't for you.
Now, here's a really confusing point I want to hammer home. You mentioned putting a business into the policy. Does that mean I get to avoid capital gains tax when I finally sell the business?
This is the single most common misconception, and we need to be crystal clear. Contributing a business to PPLI does not avoid capital gains tax on the current value of your business.
Okay, hang on. Let's break that down because that sounds really counterintuitive.
If you have a business worth $50 million today, and you contribute it to the PPLI policy, the IRS views that as a deemed sale. It's a taxable event. You pay the tax on that $50 million value now.
So if I have to pay the tax anyway, why would I do it?
Because you are protecting the future growth. Think of it as paying tax on the seed, not the harvest. If that $50 million business grows and then sells for $200 million 3 years later,
That extra $150 million of growth happened inside the policy.
and that $150 million is tax sheltered. It's about protecting the delta between today's value and the future exit value. But you have to have the cash on hand to pay the tax on that transfer today.
That is such a critical distinction. Okay, one more downside. What about the person on the other side of the table, the buyer?
Yeah, strategic buyer confusion. If you're selling your company to a smaller, less sophisticated buyer, and they find out your business is owned by a life insurance trust,
They might get spooked.
it adds complexity to the due diligence process, for sure, which all leads to the all-or-nothing fallacy. You should never, ever put 100% of your net worth into this.
You need deployment capital for the PPLI, and you need lifestyle liquidity outside of it.
Exactly. You don't want to be taking a loan against your policy just to buy groceries.
So let's say I've listened to all this, and I'm thinking, okay, I have the $10 million, or I have that big exit coming up. I want to talk to someone.
Yeah.
How do I even start that conversation?
You have to find a specialist. But, and this is so important, not all PPLI specialists are the same.
How so?
Some only handle cash. They are great if you just sold your company and have $20 million in the bank. But if you're trying to contribute a business, that complex pre-exit planning we discussed, you need a specialist who has deep experience with that.
So I should literally ask them, have you structured policies for business owners who are planning exits?
Yes. Ask for references. Ask for a total all-in fee breakdown. Ask specifically about their experience with non-cash contributions. It is a completely different skill set.
It sounds like there's a readiness checklist. Do I have outside liquidity? Am I okay with the fees? Is my timeline 10 years or more?
That's it. If you can't check all those boxes, you shouldn't even take the meeting.
Okay, let's make this real. We love numbers on this show. Can you walk us through a few quick, illustrative examples of what this looks like in practice?
Absolutely. Let's do 4 quick scenarios. First, example 1, cash deployment. Simple. You sell your company, you pay your taxes, you're left with a big pile of cash. You put $30 million into a PPLI. Over 20 years, let's say it grows to $120 million. That's $90 million in growth.
And outside the policy, that growth would have been taxed along the way.
Right. You'd probably pay, maybe $18 to $20 million in taxes on that growth over the years. Inside, zero. You just saved $20 million by changing the container.
That's powerful. Okay, what about the more complex business contribution example?
This is example 2. You own a business valued at $100 million. You contribute 50% of it, so $50 million worth, into the PPLI. Now remember, you pay capital gains on that $50 million transfer immediately.
That hurts a bit up front.
It does. But then, 3 years later, the whole business sells for $200 million. Your 50% stake inside the policy is now worth $100 million. That growth, that $50 million jump from transfer to sale happened inside the wrapper, that's tax-free. Plus, any profits the business made during those 3 years were also tax-free. You could easily be looking at total tax savings of $15 to $19 million.
That's huge. And the estate angle.
Example 3, generational wealth. You put $50 million in, it grows to $200 million over your lifetime. You pass away, the money flows into a dynasty trust. Because it's life insurance and structured properly, it generally bypasses the estate tax.
And if it wasn't in the PPLI?
If that $200 million were just sitting in your taxable estate, the government would take 40%. That's $80 million. Just gone. With PPLI, that $80 million can stay with your family.
A staggering number. And finally, just to hammer home the liquidity point one last time.
Example 4, liquidity access. You have your money in the policy, but a great real estate deal pops up.
Yeah.
You need $5 million, fast. You don't sell assets, you just call the manager.
I need a loan.
They wire you $5 million. You pay, say, 1.5% interest back to your own policy. You do the deal. Eventually, when you pass, the death benefit pays off that loan. You essentially became your own private bank.
It really is a different world of finance when you get to this level. It's complex, it's high stakes, but the math is undeniable if the fit is right.
That's the whole ballgame, if the fit is right. It is an incredibly powerful tool, but it requires a very specific set of circumstances and the right mindset.
Well, this has been an eye-opener. It's clear that PPLI isn't just insurance, and it isn't just investing. It's a hybrid legal and financial structure for a very specific type of owner-investor.
Absolutely. It's all about efficiency, protection, and very, very long-term thinking.
To wrap up, PPLI is a powerful tool for the right situation, but it's not for everyone. This episode was designed to give you a framework for evaluating whether it's worth investigating further. If you decide to explore it, find experienced professionals, ask tough questions, and make sure it fits your liquidity needs, tax needs, investment philosophy, estate goals, and the people you'll be working with. Thanks for learning with us today.